We're just waiting. Hello, everyone. We're just waiting to make sure everybody has joined the meeting before we start. Waiting a couple more seconds. Still ticking in here. So I'll just make sure that everybody is on board. Okay, I think I will start. So good morning and a warm welcome to our event on trade trends with Sweden and Economic Outlook 2021 in collaboration with Western Union Business Solutions. During this past year, we have shared events across the borders with other Swedish chambers of commerce, and at this event, we are in partnership with the Swedish Chamber of Commerce in Slovakia. So welcome to all of you. My name is Eva Fiorenzoni, Managing Director of the Swedish Chamber of Commerce, and I will be your host today. The current pandemic has shaken the global trade and supply chains in an unprecedented way. It's the largest shock for the markets since World War II, followed by unprecedented stimulus from the governments and EU. We have invited speakers from Western Union Business Solutions to give us an overview of global and European pandemic recovery scenarios and discuss trade trends currently impacting international supply chains. They will also focus on currency volatility and its effect on the Swedish krona. It's now my pleasure to introduce our two speakers. We have Beat Merkli, Country Director for Switzerland, who will make a short introduction to Western Union Business Solutions. And our keynote speaker today is Boris Kovacevic, Forex and Macro Strategist at Western Union Business Solutions. So before I hand over to the speakers, I would like to quickly remind you of the housekeeping rules. So your camera and microphone are automatically turned off during the whole webinar. If you wish to ask a question to the speakers, which we hope, you can type in your questions in the Q&A function at the bottom of your screen, and you can enter the questions as the presentations go, and we will pick up the questions at the Q&A session after Boris's presentation. If you would like to ask a live question, you can raise your hand and we will unmute you so you can ask a question live. If you have any technical questions, you can send us an email to info.zurich@swesham.ch. And please note that this event is recorded and it will be made available to you after the event on demand. It's now my pleasure to hand over the word to Beat Merkli. Welcome.
Thank you, Eva, for the introduction, and also a warm welcome from my side to this webinar. It's a pleasure to have you all here, and hopefully we can add some value to the time you spend with us today. So I would like to quickly introduce Western Union Business Solution actually, and if we can have the next slide, please, Eva. You all may know Western Union, but mostly from our money transfer side, obviously, where you can send money into a lot of countries, over 200 countries and territories, actually. But as you can see, Western Union has not always been just about money transfer. We've been in the business for over 170 years, actually just had the anniversary a couple of weeks ago. And we are obviously a company that has transformed quite many times in these 170 years. Next slide, please. As you can see, money transfer was introduced 150 years ago, actually, in 1871, after 20 years in the telegraphic business, if you want to say what most people don't know is in 1945, Western Union introduced the microwave transmitter, and in 1974, it's not 1874, it launched America's first commercial satellite. So quite innovative, and at the time, a digital company already. Most important for us here at Western Union Business Solution, our part of the business was launched in 2010, and it was taking over other businesses like this that we have today, from TravelX, as well as in Switzerland from Rüesch, which has been in the business for 35 years. So today we are obviously in the FX space, being that money transfer, being that also business transactions. Next slide, please. So what do we do at Western Union Business Solutions? We're actually serving over 60,000 clients worldwide. We are sending money, or we're able to send money to over 200 countries and territories, where we obviously also have a lot of knowledge about regulation, compliance, and the like. So that's where we have our core competency. We can process 130 currencies outgoing and over 30 incoming currencies. Next slide, please. So who do we serve? Mostly we add value to the business of smaller and mid-sized companies, but also small corporates. We also have a stake in financial institutions, where we are the provider of services. We have some verticals that we serve, that being legal, NGOs, where we can also have cash out payments in countries through our agent network, which is obviously quite important to them and no bank can offer. And then, for example, for education, universities and the likes, where we have incoming solutions that students worldwide can pay the funds in their local currencies, and we transfer the money to the respective education company or organization. Next slide, please. So mostly and foremost, we are in the FX space, and this is also then the topic of the presentation of Boris, where we are able to mitigate the risk of FX volatility, manage the costs, obviously, since we have our own network worldwide. We don't work with correspondent banks, but we have our own 500 bank accounts. This leads to avoiding unnecessary fees, but, and this is on the right-hand side here, I mean, most value I think we bring to the clients with hedging tools, where we are able to mitigate the risk to their margins coming from Forex exchange rates by, for example, having hedging tools like forwards, options, where we can also have you protect your exchange rates or participates in exchange rate fluctuations in your favor, and then obviously market orders, where you can have a strike at a certain currency rate that is achieved. So this is it in a nutshell. I think that was my last slide. Is that correct, Eva? Yes. So without further ado, thanks again for taking the time. I'd like to hand over to Boris for the in-depth analysis. Thank you.
Well, thank you very much, Beat, for the introduction. And again, just a special credit and thanks to the representatives of the Swedish Chamber of Commerce in Switzerland, to Annette and Eva, for actually making this webinar today happen. A warm welcome as well to everyone listening to the webinar today. What I would like to maybe do in the next 25 to 30 minutes or so is to basically give an outlook on global and European economic growth for this and for the next year. And to be in line with the expectations, I will be following the exact structure as I outlined here, that was promised in the invitation to the webinar and was promised on the website of the Swedish Chamber, meaning that we will look at three distinct but still kind of interlinked topics of economic growth, international trade, and then Sweden and the Swedish Krona. As one kind of last disclaimer before we jump to the first slide, there are 15 slides that I want to present today, and I've prepared quite a lot of charts because I still think that these visuals are kind of the best way to convey complex topic into a simple way. But every chart is explained by myself, and every chart contains as well just a short summary or description of the chart on the bottom. So without further ado, we can already start with the next slide, which gives us kind of a rough estimate or guide of what expects us in the next half an hour. And the presentation, as I've said, is split into 3 distinct parts. First, we're going to look at the course of the pandemic in the last 12 months, how it actually changed the global economic outlook, and what kind of we can expect for the next 2 years, let's say. And I think that understanding the process of how the pandemic actually shaped the economic recovery and how it shaped the thinking of policymakers is really important for actually understanding international trade for the next 2 or 3 years. Then we will shift to, as I said, international trade. We will look at what can we expect for this in next year for European companies and for global companies, and what are the main, let's say, short to medium risks for our baseline scenario for this year. And then we will follow up and conclude with a short guide on the question of why all of this matters for Swedish companies and for European companies as well, and how this impacts currencies and the Swedish Krona. So yeah, we can go to the next slide, which again, like I said in the beginning, I think it is really important before we get to the forecasts for global growth and for international trade. It is really important to really understand how the pandemic played out in the last 12 months and how it changed, as I said, the way policymakers approach the pandemic and approach economic growth, and how companies can detach themselves a little bit from all these risks. So starting with the cause of the shock, I think we all know that the pandemic caused quite a headache, quite a panic on markets. And it all started with the spread of the coronavirus, I would say, outside of China. So already in early February in China and in early March in continental Europe, we started governments restricting public and economic life in a kind of a pursuit to reduce the risks or reduce the contamination of the virus. And what we can see in, for example, the second chart in the middle here is that there is quite a strong correlation that we have seen between the stringency, so the strength of the lockdown, and the following economic growth. So there is a clear negative correlation between how strong the lockdown was and what economic growth we have seen. And the stronger the lockdown was, for example, one of the strongest was at a short time in the UK, the stronger the economic contraction was, let's say, in the second quarter. But what is positive to note is that the correlation has changed a bit since the second quarter. So now, for example, even though we're in a quite strong lockdown in Europe, we have not seen as harsh of a contraction in economic activity, because we know that companies, that consumers, and that governments have kind of adapted to this new, let's say, new normal and the new pandemic. So one question that we can already ask is, how did all of this, how did the rising infections, how did the lockdowns that governments imposed, how did all of this influence markets? And we can pretty much say that the stock markets, the bond and the currency markets did go pretty much in panic in early March, and we see quite a strong freezing of financial markets globally, because they pretty much started pricing in the worst possible scenario that they could think of, because we didn't know how strong or how severe the virus should be. And this is basically seen here in the chart, which shows us that the S&P 500, which is the most common used stock indicator in the United States, has lost almost 1/3 of its value in just 23 days, which is really quite a strong sell-off, looking at historical and past sell-offs. So one thing that still has to be mentioned is that even though the sell-off was quite strong, as we can see here, the following rally was as well quite strong. So what we can see here in the chart is that in the next 3 months that followed after the sell-off, the S&P 500 pretty much eliminated all its losses. And if you look, for example, at the previous crisis, this is quite unprecedented. So this kind of still begs the question, the obvious question of how can it be then in a year where the global economy contracted by the most since the Second World War, how can it be that the S&P 500 recorded such immense gains, and not only the US economy and the US stock, but also European stocks? How can it be that in the last 12 months we have experienced the strongest equity inflows ever recorded, with February this year being the strongest equity inflows ever? And the basic question, or the basic answer to the question, can be seen in the next chart, which is that the recovery of these risk assets is basically a function of two things mainly. And the first one is the unprecedented level of stimulus that governments and central banks have provided markets. And the second part of the equation is that markets just hoped for a better future. So they hoped for a strong vaccination research, and now in the beginning, and now the hope is quite strong for a really fast rollout of these vaccines. So if we basically just look here at the first chart, which shows us kind of the value of fiscal stimulus per region or per country, we can see that the fiscal stimulus that the governments provided to consumers and to businesses in the last 12 months was one of the highest we have seen since the Second World War. So it really is unprecedented in normal peace times. And this means that we have seen debts globally rise by 24 trillion US dollars, which means that the global debt to GDP ratio, so meaning how much debt is there in relation to economic growth, actually rose by around 35% to an all-time high, which is currently at around 335%. But the second thing to the equation is as well that not only have governments provided stimuli, but central banks also came in and provided much more stimulus than we have seen, for example, in the previous crisis. So just as an example, in the last year, we have seen more than 200 interest rate cuts. And currently around 60% of central banks have interest rates of less than 1%, which is a record low, historically speaking. And even though this has kind of sparked the debate of what this all means for the long-term future, how this debt can be financed, will it be financed by taxes, what is the long-term effect of higher debt? In the short term, this was very positive for the economy and for markets as well. And this is something we can see in the third chart, which is here I wanted to look at probably the most prominent leading indicator for economic growth, which is the Purchasing Manager Index for the manufacturing sector. And what you can see here is the clear contraction in 2020 and as well in 2019, and then the clear uprise following kind of the worst of the pandemic in the second quarter. So we can say, for example, that global purchasing manager indices are currently at a highest rate since 2011. And if we look at Switzerland and Sweden, the manufacturing sector is expanding at the fastest rate since at least a couple of years. And around 60 to 65% of companies in the manufacturing sector in Sweden and Switzerland have said that in March this year, they have experienced some kind of growth compared to last month, which is really a strong number. So with all this in mind, we know how the pandemic has evolved, and we know kind of what it means for the global economy. We can start to look at the first forecasts in the next slide. And one main theme that obviously kind of, if you wanted to summarize the whole theme of economic recovery of last and this year, I would basically pick one theme, which is that after recording the largest contraction last year since the Second World War, to this year, the global economy is expected to record the strongest growth since the 1970s. And I think this has very positive effects for companies, so for earnings, for sales, and has quite a positive effect of unemployment rates as well, because with economic growth, normally we see a decrease in unemployment rates. And if we wanted to kind of look more in depth into these forecasts that we see here, so what do we see at this chart? We see on the left-hand side in orange the economic contraction in the last year for different countries, and they expect the growth for this and next year. This year in green and next year in black. And if we want to break down this one big theme into a couple of more themes to better understand what is going on, we can start to do it with the first two, which are particularly important for institutions like, for example, the World Bank or the International Monetary Fund, because what we have seen clearly in the last year and what we'll expect this year is quite a sharp divergence in how well different economies and different regions cope with the crisis. Why? Basically just because countries have different preconditions before the crisis. Countries had different infection rates, different infection projections. They had different ways of coping with the crisis, be it via lockdowns, be it via stimulus measures and so on. And what we have seen is basically a very strong divergence of different countries. And one theme is the underperformance of the Eurozone, the United Kingdom, and Latin America. And one thing that basically copes all of them together is very poor, or at some point, very poor policymaking and crisis management. So the UK, for example, experienced the largest contraction last year in the last 300 years, which was quite severe. But looking, for example, at the third theme, we can see that Asia, China, and particularly emerging markets have outperformed the world economy. So China, especially, even though it recorded the lowest growth since around the 1960s, it still recorded, it was the only large country that actually recorded growth in the last year. And the second, or the last thing I want to mention is something that I've dubbed the Anglo-American story, which is kind of the narrative that was created a couple of months ago, that the strong vaccination rollout in the United Kingdom and the United States will actually lead to much better growth for this year and lead to a much faster easing of lockdown measures, which is very good for these economies. So I think if we go to the next slide, it is still, again, very important to look at the United States and China. Even though this is kind of a European outlook, it can't be understated how important the US and Chinese growth is for Europe, especially because these are two of the main trading partners for Europe. And the US is, as we will see, the largest import of the world, and China is the largest export of the world. So it is important for global trade. And one thing that kind of binds the US, for example, together with Europe is via the recently passed US stimulus package in the United States. And if we just focus here, for example, on the green bars, which represent the potential gain in trade that we will see that is contributed to the new fiscal package, because the fiscal package increases income in the United States, increases economic growth. This could lead potentially, if you look at the forecast, to much higher exports to the United States, which is important. But it is not only linked to international trade, it is also linked to economic growth. So if you look, for example, to the latest forecast from the OECD, we can see that they forecast that just alone from the stimulus package, global growth could increase by around 1% more than previously expected. And on the next slide, we can start to question of why is it that the US is expected to outperform the rest of the world and Europe. And one basic thing that I wanted to do is summarize it in just two main charts, or just two main themes, which is basically on the left-hand side, the much faster vaccination rollouts in the United States compared to, for example, different regions of the world that we have seen. And the second thing on the right-hand chart is, as I mentioned multiple times, the unprecedented measures that the government in the United States has taken and the central bank. Just for example, last year, the United States ran a budget deficit of $3 trillion, which is around 70 to 80% of the GDP of Germany, which is quite important. And this kind of boosted economic growth in the short term. It boosted household wealth. Just for example, if we look at the end of last year, US household wealth, so how much wealth US households hold, increased to $147 trillion, which is quite important for the economy. Because with the easing of lockdowns, we are expecting that some of the income, some of the excess income will be spent in the economy, and not only in the United States, but as well for European goods and services. Next slide. I think just to briefly mention that I've already done, why is the US important? Why is China important? Well, both of the countries if we look at the latest IMF forecast, I expect it to generate around 35% of global economic growth this year. So it is important for the global economy and for Europe. And as we can see, China is the largest export nation in the world, and the US is the largest importing nation of the world. So it is important for importers in Europe and exporters as well. And this chart, I think, highlights really well the dynamic of the post-pandemic world, which was basically that during the pandemic and now, we've seen basic two themes. The United States started to import massively goods, which we can see here in the orange line, because what this represents is basically the trade balance, which is exports minus imports. And the second theme that we have seen is that Chinese exports pretty much exploded last year because everyone needed these pandemic goods, and something that China has provided. But one thing, for example, for China that I want to mention is that I think that these gaps should close in the near future, because with the easing of lockdown measures in Europe and in the rest of the world, we will see that a kind of a shift of the consumer preference going from just buying pandemic goods and services to spending more money on services, on tourism, for example, for this in next year. And this, I think, could dampen export growth in the coming months for China. But next slide, please. So I think now we can start to look at global growth and international trade. Now that we understand how the pandemic played out and how important the US and China are for international trade. And we can already see that the last year was quite painful for world trade. We can see one of the largest contraction in at least a couple of decades. And this has been followed by quite a strong extension of economic growth and as well for economic trade, because we have to just be aware that world trade makes up around 60% of economic growth and on the world economy. So it means that the forecast for economic growth and world trade is quite interlinked. And that means that even though last year we had a contraction of world trade of around 5%, this year we will see, if we look at the latest forecast from the World Trade Organization, we will see an expansion of world trade by around 8%, followed by an expansion of 4% in the next year. And here I think it's really important still to mention two main facts. And the first one is that it is a quite positive one, actually, which is that we are already at the current stage, looking at data from February, we are already in terms of world trade, we're already at pre-pandemic levels. So the world trade volume that we're currently seeing is already at pre-pandemic level. But the one negative aspect of this is that we can't really compare it with pre-pandemic levels, because world trade was already decreasing in 2019 because of the US-China trade war. So what we would have to look to kind of gauge how good we're currently standing is we would have to look at the pre-pandemic trend of the last couple of years. And looking at this trend and the latest forecast from the WTO, we can see that there's a very high chance that we will not see or not touch this pre-pandemic trend in the next 2 or 3 years. And this is something to keep in mind, because there is still an ongoing debate if the current uprise in the economic growth and international trade is more cyclical, meaning it's really short term, or if it can be extended into kind of a long structural change, meaning long-term higher growth for world trade. And I think this is still uncertain to this point. So on the next slide, I've tried to answer this question in a short way. So is this cyclical or structural? And one thing that will influence the answer to this question is basically these 4 topics. And even though I'm only going to mention 2 of them, short and the medium term, left the first 2, just because time constraints of every webinar is the first one. And I think that talking about geopolitics in this sense and regionalization would kind of be beyond the scope of a normal webinar. But I still think that for companies today, and looking at the forecast for this in next year, it is important to look at the first 2, which are short and medium term risks for the global outlook. So on the next slide, this is exactly what I've tried to do with the global supply chain, because I think we all know that recently there have been quite a strong indication of bottlenecks in the global supply chains. that maybe some of the representatives of the companies today have experienced as well, because we know that in recent months there has been quite an explosion of commodity prices and a sharp demand in manufactured goods around the world, and this, in combination with kind of a supply side bottleneck on container ships that we have, caused, first of all, shipping rates to explode. We have seen a 400% increase in shipping rates from Asia to Europe and Asia to the United States. And we have seen that many more companies have experienced some kind of problem in regards to global trade. So if you look at the latest IHS Institute survey, around 8% of European companies in February have experienced some kind of problem in terms of their global supply chains. And 8% is much less than, for example, in the United States, but it is still 4 times higher than our pre-pandemic levels of around 2%. And one side effect of this as well was that we have seen quite a strong increase in the delivery times of goods and services. So if we, for example, look at the right chart, which tells us how high delivery times are in the United States and Switzerland, we can see that they are, for the United States, they're at the highest level since at least the 1970s, and for Switzerland, the highest in at least the last 25 years, which is quite severe. And I think that even though in the next months they should kind of dampen, I don't think that we will see pre-pandemic levels this year, which could be a problem for some companies, especially if on the next slide we start to look at currencies, at the US dollar, and look at inflation and how it plays out. In the latest survey, for example, of the, I would say the most important survey for financial markets, which is published by the Bank of America, we can see that for the first time since pretty much the pandemic, investors in the survey have started to worry about inflation and the rising interest rates. And for the first time since the start of the pandemic, these worries have overshadowed the pandemic worries and the COVID-19. So investors and fund managers have already moved on from COVID-19 and the pandemic, and have already started to look at the question of how will this economic growth impact currencies, and how will it impact inflation. And I still think that this is one of the most important questions to date in financial markets, which is basically that, can growth be too much? This is what we're currently asking, because if growth rates are so strong compared to last year, we are expecting some kind of inflation. And this inflation in goods and services, and in the kind of the commodity inflation, has to be translated at some time in higher prices. And then the question is, higher prices meaning, will companies be able to roll over these higher costs, these higher input costs to the consumer, or won't they? And if they are not able to roll over these costs, then they would have to have some kind of worsening of the sales prospect for this and next year, which is, I think, very important. And the second part is as well the US dollar. I think we all can acknowledge that the US dollar is kind of the dominant currency in global trade and in global financial markets. And even though there is, I would say, not a strong causal relationship between the dollar and world trade, we can acknowledge that they're somehow interlinked. So we have seen that in periods where the US dollar really strengthens, the global trade kind of goes into a downtrend for various reasons. And that is why, even though for European companies, it is very important to look actually at the US dollar and what the US dollar is doing. But on the next slide, we can start to conclude what all of the previously mentioned, the pandemic and economic growth and international trade, what does it matter for Swedish companies? And the first thing I think everyone knows who is importing from Sweden or exporting to Sweden knows is that Sweden is quite, as almost every European country, quite an open economy and quite a globally oriented economy. So if we look at the first chart, for example, it tells us that around Swedish trade, which means imports and exports together, account for around 90% of Swedish GDP, which is quite a lot. And it can be compared in some parts with, for example, the Austrian or the German economy, which are as well kind of quite manufacturing heavy and quite export heavy. And one thing as well, why it is all important, is that around 45% of Swedish trade is done via non-Euro countries, meaning that currencies are important and volatility is important, especially because around 55% of Swedish exports are invoiced in euro, and around 25% are invoiced in US dollar. So this is why it is important. A second thing that I want to mention, that the Swedish krona is quite pro-cyclical, meaning that if we expect an uptick in economic growth and in international trade, this is something that is quite good for the Swedish krona. And if we're expecting a downtrend like we did in the last year, we have expected, which kind of came true, that the Swedish krona would depreciate with most of the other riskier currencies. But even though, for example, this relationship held very strongly from the year 2000 to, I would say, the peak of the European debt crisis 2012, we can still say that this relationship kind of broke down with the kind of with the solving of the European debt crisis, because the Swedish krona was actually in a downtrend, looking at trade weighted averages, pretty much through 2012. So the last 7 years, the krona had kind of a steady depreciation trend. And the question is that this cannot really be explained by just looking at indicators for risk assets. So in the next slide, I just again want to mention the fact, which is very important, that the Swedish krona is pro-cyclical. And this is something we can see on the left chart, which basically just tells us in orange, we can see the yearly change of the Swedish krona. And in black, we can see how strong economic data is in the Eurozone. And this is not quite unusual that the Swedish krona is correlated with European growth. You can see the same with the Czech crown, with the Polish zloty. All these European non-euro currencies have strong correlations with Europe, because Europe, or the Eurozone, is the biggest trading partner of these countries. And it is why, just looking at this chart, you would expect the Swedish krona to have a bit of potential of appreciating in the next couple of months. But I will then show why this is maybe not as true as it should be. But before we come to that, we can see on the right side, and with the chart, that last year was quite a volatile one, that we can see with the orange dot. So the orange dot is the highest volatility the currency has experienced in the last couple of years against the US dollar, because the US dollar is kind of the benchmark we are benchmarking currencies from. And you can see that there were quite some severe, let's say, sell-offs of some currencies, especially in the emerging market world, where, for example, the Turkish lira in 1 month depreciated almost 50%. One thing that is important to notice as well, the Norwegian crown, which is as well very volatile for a G10 currency, for a developed market currency. So if we just focus on the Swedish krona, we can see that the Swedish krona is not looking just at volatility. It is not quite there with, for example, the euro and the Swiss franc, but it is definitely not an emerging market currency, let's say, because the sell-off of the Swedish krona in the peak of the pandemic was much less. If we look at the yellow dot at around 12%, was much less than what we have seen in some emerging market countries, and even less than, for example, the British pound. So currency volatility is important, obviously. If we, for example, look at the black bars now, they show us the average monthly volatility for different currency pairs for the last couple of months. And we can see that the Swedish krona has around the monthly range of 4%, which is quite high for some countries, because not everyone can roll over these exchange rate risks on their consumer prices. But again, still, it is kind of positioned in the middle between the big three currencies and the emerging market currencies. But one thing that has to be mentioned on the next slide is that, as I've mentioned, this pro-cyclicality of the SEK cannot explain the whole movement or the whole downtrend of the Swedish krona for the last couple of years. I think the main perpetrator of this just has to be the decreasing of interest rates in Sweden, and especially the starting of quantitative easing in Sweden, meaning that the central bank in 2015 started buying government bonds. And given that the government bond market in Sweden is quite a small one, this means that it drains the liquidity out of the bond market. And this kind of decreased the yield, so the interest rates that investors get from investing into Swedish bonds. And this made the Swedish krona much less, I would say, competitive or attractive to other countries. And this is what we are seeing in the second chart, for example. In black, we can see the interest rate differential between the G3 countries, so Eurozone, the United States and Japan as an average, minus the Swedish government bond rate. And we can see that it was a clearly downtrend from I would say 2014, when Sweden kind of started this downward cycle of interest rates. And you can also see that the Swedish krona really followed this trend downwards. And on a trade adjusted basis, the Swedish krona actually made quite a significant uptick in 2020. First of all, because of the very weak US dollar, and second of all, because of the very weak Norwegian crown. And given that this is a trade weighted index, it kind of takes all of these exchange rates together. So USD SEK, Euro SEK, SEK NOK, and so on. But yeah, I think on the next slide, we can pretty much conclude with the main part of the presentation. Again, I think there are a couple of charts that were quite interesting, and I know that 15 slides are maybe quite a bit for some to handle, but I think that the main conclusion of all of this is still very simple, which is basically that last year we've seen one of the strongest contractions in economic growth since the Second World War. And now with the easing of measurements, with the vaccination rollout, with all the government and central bank stimuli, we have seen, or we're expecting to see one of the strongest upticks in economic growth since the 1970s. But one question again is this growth cyclical, meaning it's only going to last 1 or 2 years, or is it really a sustainable growth path for the future? And one thing that will decide that is actually inflation rates, because if the growth is too high in the short term, and if inflation rates spike, especially in the United States, which is always kind of a leading indicator for inflation, it could mean that the US dollar spikes as well, meaning that it would drain liquidity from global financial markets going back to the United States. And this would be bad for, I would say, global growth, growth in international trade, and especially for risk assets like the Swedish krona. But I think that pretty much concludes the first part, and I'm happy to take any questions.
Thank you very much, Boris. Very interesting. We actually have a question that just popped up here. It's from Inge Schütz, and she's asking what impact the digital currencies like bitcoins, etc. What role will they play in the future?
Yeah, thank you for the question. I think it's a very relevant one for today. It is quite an important topic. I would say it's probably one of the most important topics for central banks currently, because if you're looking at the research that central banks are doing, especially in Sweden, for example, because the Swedish central bank is the oldest in the world, and it always had a character of experimenting with new stuff. It was one of the first ones that introduced negative rates. It was one of the first ones that introduced quantitative easing, so buying government bonds. And it is the first one who really explored the possibility of central bank digital currency. We still think that in the short term, it probably shouldn't be something to look into for private companies, just because there are a lot of hurdles that central banks face in implementing these digital payments. In Sweden, for example, it was a plan to come out with a pilot this year, but they actually extended the deadline because there were some kind of hurdles that still had to be managed to really have kind of a pilot going on. So it is definitely a question for the next, I would say, 5 to 6 years, more in the medium to long term. Short term, I don't see it playing a role, because the central banks don't want to be too hesitant and implement an unfinished product. So short term, not really, but medium to long term, it is really something that will probably change how we look at currencies and the banking sector.
Thank you very much. So just to reiterate, it's your opportunity now to be able to ask any questions. So please type in your questions or raise your hand if you would like to ask a live question. So take this opportunity to ask the question to Boris. In the meantime, I have a question for you. I mean, we're talking a little bit about the interest rates. When do you think the Federal Reserve will start raising the interest rates?
Yeah, that's a good question. I think that's pretty much what everyone, every company and every analyst is kind of trying to figure out, because the US, as I said, I think we can't understate the fact that the United States, in terms of policy making and central banking, is kind of leading the world. And as we've seen after the financial crisis, and as we've seen in 2013, what the central bank in the United States does and what interest rates and inflation do quite impact Europe and emerging markets. Let's say if we look at the last time that the central bank started to decrease actually the liquidity in the market in the United States, which was in the year 2013, which is called the taper tantrum, we could see that emerging markets in the following month experienced one of the largest equity outflows ever recorded. So it is really important what the Fed does. I think to the question of when we can expect to see interest rates rising, I think we've not really seen a unified picture within the Federal Reserve. There are some members like the President Powell that has said that inflation is not that important and that he looks at unemployment rates. And as long as we see unemployment rate that is higher than kind of the natural rate, they will not signal interest rate hikes. And before they signal interest rate hikes, they said that they will clearly communicate that first of all, they will start to reduce the liquidity via the bond buying. So markets I think it will not be just out of the blue that we see interest rate increase. We will first see a tapering down of the quantitative easing, and then maybe following a couple of months or a year, we will see interest rate hikes. But currently, there is also a very important point. There is a divergence between what the Federal Reserve wants us to think and what markets think, because markets are expecting 3 interest rate cuts interest rate increases by next year. But the Federal Reserve says that they don't want to increase rates for the next 3 years. So it's a question who we want to believe. I think it's kind of in the middle. I think that inflation in the short term will be higher than we expect, and it could scare markets. So even though the interest rates don't come too early, markets could still anticipate interest rate cuts. So even though it wouldn't matter if they come or not in this year, if markets are expecting them, yields would rise, inflation would rise, and this would be a problem for risk assets like the Swedish Krona. So I think there is no one clear answer, but again, markets are expecting 3 interest rate increases next year. The Federal Reserve is not expecting any.
Thank you very much. And what about Sweden? What is the outlook for the Swedish interest rates? They follow the rest, of course, but what do you think?
I think Sweden is quite an interesting example, because the Swedish central bank actually tried to after a couple of years of negative interest rates, it tried to raise it into positive territory. Now we're around 0% at the lower bound. But I still think that markets and the Swedish central bank are not expecting any interest rate hikes for at least the next 2 or 3 years. And it's the same for the European Central Bank. So both of them are very inactive at the moment, looking at just interest rates. And this is why we can maybe go back to the previous slide if you want to. This is why I had 2 charts brought with me, because the left one is short-term interest rates, what the central banks are setting. I don't think that they really reflect the exchange rate, because they are pretty much stagnant currently, and no one is expecting the Riksbank or the ECB to change this outlook for the next 3 years. And this is why we have to look at long-term rates, which is on the right-hand side, because on the right-hand side, we can see the interest rate for the 10-year government bonds. And there you can always see that these are much better to forecast or to predict currency exchanges. So I think that even though we're not expecting any change in short-term interest rates, it could still be that Swedish 10-year yields, so the interest rates on a 10-year government bond of Sweden could go up, and going up would mean a stronger Swedish krona. So I think it is important to make the distinction of short-term, which we don't see any movement whatsoever in the next couple of years, and long-term, which could actually move up in this year.
Okay, thank you very much. We actually have a live question from Beatrice Bondi. Could you please unmute her, Annette? Welcome, Beatrice.
Thank you very much for an absolutely outstanding presentation, one of the best I've seen, I must say. I'm with Investor EB and chairing the Swedish Chamber of Commerce in Switzerland. I have a question regarding the markets, of course, because the stock markets have been absolutely crazy in the last few years, with, of course, volatility depending on rumors and expectation about interest rates rising. But how much do the interest rates have to rise to really create an alternative for investors to stocks. I mean, it's the bond markets are still have to go a long way to become attractive for investors.
Thank you for the question. I think this is a very strong question, because there was actually a survey that the Bank of America did as well that I've mentioned, and they basically asked the same question to fund managers around the world: at what rate would bonds be an attractive alternative to stocks? And a lot of participants, mainly I think 30 or 40%, said that around 2.5%. Or 2-3%, it would start to get attractive and be really a pain for stock valuations, because we have to remember that stock valuations are at a record high. I think in the last 100 years we've only seen 2 periods where we had higher stock valuation than currently. So I would say that stocks are very vulnerable to an increase in yields, but the liquidity is still so high, and the kind of a base effect of growth is so high that markets are pretty much ignoring any short-term risk. For example, the one thing that you can mention as well is that even though Joe Biden, for example, now said that he wants to increase the corporate tax and the corporate tax for international US economies, we didn't really see any movement of stocks whatsoever, even though looking at the forecast from Goldman Sachs, if these tax increases would be implemented, US economies would have a earnings to growth ratio of 9% less than now. So it is quite severe, but stocks really didn't care because the liquidity is so high and the expectation for global growth is so high. But to go back to the question, I think that 10-year bond yield of 2% or 2.5% would, I think, start to hurt stocks, even though it would still be a negative real yield.
Thank you.
Thank you for the question.
Thank you very much, Beatrice. We have another question here from Inge Schütz again. She's asking a little bit about the lockdown strategy versus the Swedish open economy. So can one read from your charts how much the Swedish open economy against the German or French lockdown COVID strategy was economically damaged?
Good question. Thank you. It's quite controversial to say the least. I'm not a health expert, so I can't really comment on some parts of the question. But you can, just if we look at the stats, it is very clear that there's a negative impact of lockdowns on short-term economic growth. So we can see that Sweden, we can actually go maybe to the chart where I have showed the forecast. I think it was the 4th or 5th chart. So this one, and we can see that Sweden in the middle had a much less severe contraction than pretty much almost every developed country. And this is one thing that people against lockdown have mentioned, that Sweden had coped much better with the virus and so on, and had lower death rates than, for example, continental Europe. Second thing that people are mentioning that are for lockdowns is that Sweden has quite a good demographic, and it is kind of scarcely populated, which is not the case for continental Europe. So you would have to compare Sweden with, for example, Denmark or Norway or Finland. And in this comparison, Sweden doesn't look as good. So it always depends on who you are comparing Sweden to. I think the economic downtrend was much less severe than in Europe. And if we look at the 2 biggest extremes, which is United Kingdom, had the biggest lockdown and the longest lockdown of every country in Europe, and it had almost a 10% contraction, which is really 10% in a perspective. To put it into perspective, is really unprecedented. And as I said, it's the largest contraction in the last 300 years. So if you compare complete lockdown with no lockdown would be better in the short term for economic growth. And I can only speak for economic terms and not for health issues, of course.
Thank you very much for that answer. Do we have any? Yes, we have another question here from Martin. Given that this is a Swedish talk, what is your take on the outlook for the CHF versus SEK pair specifically, and for their respective economies in general, short, middle, and long perspective?
a very good question. I think that both economies, as we have seen in a couple of slides, looking at the industry sector, for example, looking at tourism, we're expecting both economies to be experience or record very strong growth this and next year. We're clearly in a cyclical expansion, and companies in Sweden and in Switzerland should profit from that. Especially, we have seen in the US fiscal package that Switzerland, as one of the actually a large exporter to of luxury goods to the United States, should definitely also benefit from strong US and Chinese growth and strong European growth. But I would have to say the Swiss franc is quite a unique example, because the Swiss franc is, as we know, a safe haven, which means that the Swiss franc actually doesn't correlate with the economic growth of Switzerland. Actually, it is contrary. When European growth and Swiss growth is strong, the Swiss franc actually depreciates, because no one wants to hold these safe assets like government bonds, the US dollar, the Japanese yen, and the Swiss franc. So there is actually, I think personally, the best way of looking at the forecast for the Swiss franc is looking at German bonds, because both the German bonds, the German bond yields, and the Swiss franc are safe havens. So every time we see an uptick in the yields of government bonds, we see a depreciation of the Swiss franc. And given that we're expecting higher yields this year, we're expecting a weaker Swiss franc, which would actually be good for the Swiss economy and for the central bank in Switzerland. So Euro Swiss franc, we're expecting stagnation, or at least some kind of appreciation trend, if under the circumstances, if yields in the US don't rise too dramatically. And the same can be said for example, Euro Swedish Krona. We're expecting a bit of an uptick if all goes well in the economic recovery. Looking at Swiss against the Krona, CHF SEK, I would say that there is a possibility of depreciation, just because if we really see this growth that we're expecting, then there should be quite a bit of a sell-off in the Swiss franc. So it is really hard to tell. But for the specific person that asked, we can actually provide specific forecasts for currency pairs. So we would have to look specifically at this one, but we have forecasts for pretty much every currency pair around there. So if there is a demand, we can maybe provide it by email if that is what the person wants.
Thank you very much. Yes, on that note, we can also mention that if you have any questions that you would like to ask Boris or Beat, we will send out a thank you email after the event with the email addresses, so you can actually send them the questions directly should you have any. Well, I think we're going to wrap up. I would like to thank you very much, Boris, for doing this very good presentation, very interesting, very much into detail. Thank you also, Beat, for participating in this webinar. It was a pleasure working with you. So thank you very much to Western Union. We also have a thank you here from one of the delegates who thanks for a great webinar. Thank you, George. And I would like to thank all the delegates who attended this webinar. It was great to see so many of you here. Thank you very much to the Swedish Chamber in Slovakia as well. Thank you to Western Union. And as I said, we will send out an email with the recorded version of this webinar, as well as the email addresses to Beat and Boris, so you can ask further questions should you wish to. So with that, thank you very much to everyone, and see you very soon. Thank you.
Thank you, and thanks for having us and organizing it, Eva, also to the Swedish Chamber. So it was a real pleasure, and looking forward to a very strong collaboration also in the future.
Thank you very much. A pleasure.
Thank you.
Thanks, Boris.
Thank you.
Thank you.
Thank you.
Bye-bye.